Everyone, Brian Yerrick's Wyker Realtors Advantage Plus. Today I'm sitting down with Darren Poppin with Mortgage Investors Group. I have a lot of questions from a bunch of different buyers, past clients, etc. The general public. There's a whole lot changing right now in the real estate market, how people are getting financed, what type of financing they're using. And as you know, I like to stay in my lane, so I'm not going to answer them specifically. But Darren here is a senior loan officer who does have those answers that can give you the points you're looking for. So Darren, welcome. Thank you so much for being here.
Thanks, Brian. I'm really glad to be here. Appreciate that.
Very good, very good. Now, you are a senior loan officer. What exactly is the difference between loan officers, lenders, originators, mortgage brokers? I mean, there's hundreds of terms, and I think we all use them interchangeably, but what exactly is the difference, if any?
It's an encrypted language in the mortgage business. I mean, we like our acronyms, we like our little definitions and our little terms. So yeah, but I mean, really, when you're talking about a lender, an originator, mortgage broker, direct lender, secondary lender, all of those really do fall under a very similar category. At Mortgage Investors Group, we've been a direct lender for a long time, and I think that's really kind of what you prefer.
Direct lender versus
brokering or something completely different, but the direct lender model really kind of looks like in-house. We have underwriters, we have more autonomy, control, ability to move things faster or slower, but it's all done here. So a direct lender really is more streamlined, and I think that's the model for true lenders, not a bank that also does mortgages or a broker. A broker is also a term that we use a lot, and that is truly where there's a middleman. I think people recognize middlemans, they understand that, but you are, if you're choosing to use a broker, kind of using a middleman between the direct lender and an originator. I mean, a broker in some cases is also originating that mortgage. So that originator term applies kind of across the board to any loan officer / originator that truly finds the mortgage. I've always thought they should call you guys originators because really the loan does originate with you.
I can see that.
So we've talked about loan officer and originator and lender. Those are interchangeable terms. I mean, I think you can use those all the same. Mortgage broker is the middleman concept. Direct lender would be the MIG model. And then secondary market lenders is a term that's hardly ever used unless you're immersed in this business. But that's really a lender that sells those loans to agencies like Fannie, Freddie, VA, or USDA.
We're talking more Wall Street type stuff rather than the...
Above my pay grade, but yeah, that's our product. You know, we originate the mortgage, we securitize it, we go through a whole process, and it does. The majority of lenders do sell those to servicing entities, which is what you want because that money comes back in. That's a lot of our income, and it goes back into the front end for keeping things, affordable because mortgages are costly.
Hopefully coming down a little bit, and we'll get into that in a little bit, but loans in general, what type of loans do you write? Because you hear conventional, you said, Fannie Mae, Freddie Mac, you have all these different terms. They all mean something a little bit different, but to the consumer that's out there, what loans do you write?
The big four, and I like to call them the A's, the VA is super popular and used all the time, and FHA, and a rural housing program, USDA, those are the A's. Conventional lending pretty much encompasses everything that isn't an A program. So conventional, it's really designed to try to catch a lot of people. But there are times where you don't qualify conventionally, and you fall back onto other programs in that case. The FHA is a good program that catches pretty much everybody that doesn't, for whatever reason, work conventionally. A little more flexibility with debt income and credit scores is a big one. But generally speaking, between those four categories, if I can't fit you into one of those four, we might have some work to do on your credit or other discussions to talk about.
Well, speaking of which, what are you actually looking for when someone applies for a mortgage? In other words, someone calls me up, they want to buy a home. I tell them first, and we'll get into this a little bit later too, the vital importance of being pre-approved by a reputable lender before we start. So they come to you, they're looking for pre-approval, they want to apply for a mortgage. What are you looking for as the senior loan officer?
This has changed. I mean, obviously, credit's important. All aspects of the loan are important, but I feel like credit score has almost fallen a little bit to the secondary because of the Dodd-Frank ability to repay law. I mean, we now have something called ATR, that's ability to repay. But I mean, I feel like we look more closely at your income and your ability to repay the loan. Really, that's where that ability comes from, is your income. I feel like that is taking precedence over credit or assets or a lot of different things. You know, your typical scenario, I got a lot of money in the bank, but I'm not working right now. There's no income. We have ways of extracting income from assets, and we have guidelines for all those things, but truthfully, we're really looking closely at your job history, your income, how you manage your debts, utilization on your debts, revolving credit history. You know, if you got credit cards that are creeping up there, and that model's changed a lot too. It used to be a small balance on your credit card was okay. Now, in some cases, they don't even really want a small balance. They want a teeny, tiny, little, tiny balance.
Just enough to keep the account open.
Basically, that kind of thing. But, you know, overall, I think it's sort of income, credit, assets, and in that order. But stability, I think it all sort of encompasses stability.
Okay. Well, with mortgage rates trending down a bit, a lot of people have been asking me questions, kind of what you were just touching on about their credit score not being good enough, or they're worried about their job situations, how that affects them. Now you kind of touched on it, but what exactly do you say to a potential borrower, someone that wants to buy a home, that they're concerned about their credit score? They had a hiccup a year ago. Like, what do you tell them? How do you point them in the direction they should go?
Yeah, if I'm not able to make home ownership a reality, like at this moment, we definitely fall back into sort of a coaching environment. I come from a family of teachers, so I try to take an educational approach to it. And what I find is when people don't or do have bad credit, a lot of times I didn't know. You know, I didn't know. I mean, I didn't know how all this works. I didn't understand that this is how the recipe comes together. I mean, I dive in and really look for responses from that buyer that says, yeah, they're listening to what I'm saying, you know, so, you know, let's calculate your payment, and let's calculate how much balance you really need to have on this credit card. The Wayfinder, or some people call it the What If Simulator, is a really neat tool that it's literally like, you know, we can sort of slide a scale, pretend like you had a money tree and just picked your money tree clean. And like, if you had $1,000, what would you do with it? 300 here, 200 there on these two credit cards, and press a button and let's see what that does to your score. So, you know, I like to use those in really specific instances where we really have to do something. But a lot of times you can just give some advice and a little time will pass, and, you know, credit reads like a book. So pages have to turn to improve or to get to a different chapter or a different story. So for me, I take an educational approach, and I don't hesitate to really make sure that people understand where they're at and how they can improve their scenario.
Good deal. Now, there is something that I've been hearing a bunch about lately, and it sounds like someone in that position may inquire about a non-prime or a dignity mortgage. What can you tell me about them? Because I have my personal opinions, but I don't know enough, so I'm asking for myself too. I
mean, I was actually in the mortgage business in 2005 and was writing like true subprime mortgages, your 228 arms and your 327s and your pay option arms. I mean, these are crazy loans. But honestly, a lot of those loans that were truly not documenting anything, a lot of those have really fallen. Like they just aren't legally able to be done anymore. I mean, if we can't really establish that ability to repay, it's hard. Subprime now really kind of looks like, what don't the agencies do? Well, the agencies don't do this kind of stuff or that. But the most, I think, like pull through you're going to get in a subprime or non-prime or non-traditional are really for more investment properties.
Okay.
Because we can, with investment properties, there's a perceived amount of rental income that's supposed to be, coming in from that house for that area. We do catch a lot of things in a non-prime environment for condominiums that aren't warrantable. Maybe it's a double wide that, had a very strange affixation or a different way it was hooked to the foundation or just doesn't qualify. We may be able to find kind of a loophole for some of those. I think the biggest thing, like I said, has been in a lot of these investment properties, investors out there, maybe this video isn't for you, but if you do have more questions, reach out to Brian and we can, tell you more about how a lot of the DSCR loans work, where it's really based off the rental income from the property.
Okay. Well, now when I hear the term subprime, I instantly go back to 2008, the housing crisis, a 3-year period, the only 3-year period since we've been tracking property values where we actually took a dip. So as a realtor, like the red flags go up in my mind when I hear subprime. What exactly is different today than it was in '08? Now, I know you said you have to show the ability to repay. That's definitely important, but the loans itself, what exactly is different?
They're just better. I mean, I think.
How so?
2008, I think, well, that was a really good question, first of all. It's a hard question to answer, but I mean.
I'm not going to softball you that
Listen,
much.
like we had to almost totally reinvent this business. I mean, like stuff went away that we'd always been used to, things changed. It went back to just bread and butter basics. I think a lot of the underwriting tightened up a little bit, and I think that the restrictions were a little tighter for a while, and they've started to loosen. But we will never see ourselves in a day where we're writing mortgages for no income or no assets, or maybe I won't say we will never, but it would be a very risky environment for that lender to live in, where they're just really not verifying any of that stuff. But in general, I just think the loans are better.
So would it benefit a first-time home buyer? Like I said, maybe they have some credit score problems, some employment problems over the past couple of years. Like, is it worth investigating for them?
Like going into a subprime product, lenders out there, if you don't agree with me, I apologize, but I mean.
And if you don't, leave a comment. I'd love to hear your opinion too.
Yeah, I mean, I think as far as getting a first-time buyer into a home, I mean, the motto, or one of the mottos here at MIG, is it's do what's right. Like
I like that.
If a little bit of planning is going to keep you out of a 9 or a 10% interest rate and a little bit of time, and you really don't have, a housing emergency, so to speak, let's stage yourself a little bit. If I can't really catch you and qualify you with one of the A's,
right?
FHA, and I mean, not everybody's a veteran, but in veterans, it's a very flexible program as well. Probably one of the most flexibles.
As a veteran myself, I love the VA program.
It's a very flexible program, but if I can't catch you in one of the A's, we probably need to fall back to a coaching environment where we can put you in a position where homeownership is going to be affordable for the long term.
Okay, well, it sounds like no matter what situation a buyer's in, whether it's first-time home buyer with some scary thoughts about what could be, or the person that's bought 20 homes in their life and is sitting graded at 849 credit score, whatever your situation, reach out to a lender and find out what is their best option, which course they should go.
Yeah,
would you agree with that?
Well, absolutely. I mean, I'm going to take that a little further. I can't do everybody's mortgages. If I was going to say reach out to a lender, I'd say, hey, call Darren Poppin at Mortgage Investors Group.
As you should.
But reach out to a local lender, and then lean on your realtor, because your realtor has these relationships, and things will go smoother if you can align and sort of trust the process, or fall into the process is another term we use, but you got to talk to a lender, preferably not a big box online retail type lender, somebody with boots on the ground right here that knows the market.
Sounds good. Well, if there's someone out there that has more questions or wants to contact a lender like yourself, how do they contact you for their answers?
So I'm easily reached on my cell phone or my website, but my cell phone is 865-936-3965. You can find me all over the Google. My mother spelled my name with one R, Darenpoppen. I don't know why, but thanks, Mom. And I'd like to say just one more thing. Please contact me, because we take this very seriously, and it's not scary. Doing something you don't know, I get it, that's intimidating, but with guys like us on this side, like, we just really want to help. Take that step, don't be afraid, because that's the first step. If you can put the boots on the ground, we'll get you headed in the right direction.
Sounds good. And I will make sure to include all of Darren's contact information in the description of the video, as well as my own. Trust me, guys, you must reach out to pros. You wouldn't want to do this on your own. Call someone local, knows and understands the local market, real estate, mortgages. It's all about hyper-local transactions. We got your back. We are more than happy to answer any questions you have. Consultation is free with me, and we can even bring Darren in if we want to sit down and get a 3-way or 4-way point of view on this. Either way, however you want to do this, reach out to Darren and or myself, and we will put you on the right path. Sound good? Thank you much, and as always, I will talk to you soon. Darren, thank you so much.
Thanks, Brian. Had a good time.